Ever wondered how to increase your credit limit without damaging your credit score? The thought is not uncommon, and it's a valid concern. In our financial world, credit limits and credit scores are two crucial elements that can greatly impact our financial health. Credit limit, the maximum amount you can borrow from a lender, and credit score, a numerical expression of your creditworthiness, are interconnected. A higher credit limit can be beneficial, allowing for more financial flexibility. But there's a catch. If not managed wisely, it can lead to high credit utilization, which can negatively affect your credit score. On the other hand, a strong credit score can open doors to better loan terms, lower interest rates, and more. It's a financial asset, one that needs to be protected and nurtured. So how do you navigate this delicate balance? Can you increase your credit limit without hurting your credit score? You're in the right place. In this video, we'll guide you through a step-by-step process on how to increase your credit limit without hurting your credit score. First things first, it's crucial to understand what credit is and how it works. So, let's start with the basics. Credit in the financial sense is a contractual agreement in which a borrower receives something of value now and agrees to repay the lender at a later date with interest. Your credit score, on the other hand, is a 3-digit number that represents your creditworthiness. It's like a financial report card, with scores ranging from 300 considered poor to 850, which is excellent. This score is determined by several factors, including your payment history, the amount of debt you owe, and the length of your credit history. Your credit limit is the maximum amount that a lender allows you to borrow. It's determined by your income, your credit score, and the lender's assessment of your ability to repay. A higher credit limit can give you more flexibility and purchasing power, but it's important to manage it responsibly. Now, let's talk about credit utilization. This is the percentage of your total available credit that you're using. For example, if you have a credit limit of $10,000 and you've used $4,000, your credit utilization is 40%. Credit utilization is a key component of your credit score. Generally, a lower credit utilization rate can contribute to a higher credit score. Why does this matter? Well, lenders view a high credit utilization rate as a sign of potential risk. It suggests that you might be relying heavily on credit and may have trouble paying it back. On the other hand, a low credit utilization rate suggests that you're using credit responsibly, which can make you more attractive to lenders. Now that we understand the basics, let's dive into the process of increasing your credit limit. Remember, managing credit is a lifelong journey, and understanding how it works is the first step towards financial freedom. One of the first steps towards increasing your credit limit is to ensure timely payments. Now, you may be wondering, why is this so important? Well, your payment history forms a significant chunk of your credit score. It paints a picture of your financial reliability to lenders. When you consistently make your payments on time, you demonstrate that you are responsible with your credit. It's like showing up on time for a meeting. It shows respect and responsibility. On the other hand, missed or late payments can negatively impact your credit score. This is because they indicate a higher risk to lenders. Think of it this way. If you were lending money to a friend who often returns it late, wouldn't you think twice? Not only this, maintaining a good payment history can also lead to lower interest rates and better credit card offers. This is because lenders often reward responsible behavior. Remember, consistency is key when it comes to payments. The next step is to lower your credit utilization. Now, if you're scratching your head wondering what on earth credit utilization is, don't worry, I've got you covered. It's a fancy term that represents the percentage of your total available credit that you're currently using. It's one of the key factors that credit bureaus look at when calculating your credit score. So, let's say you have 3 credit cards, each with a credit limit of $2,000, giving you a total available credit of $6,000. If you've spent $1,000 across all 3 cards, your credit utilization rate is around 17%. Why does this matter? Well, a high credit utilization rate can signal to lenders that you're overly reliant on borrowed money, which can negatively impact your credit score. Generally, it's recommended to keep your credit utilization under 30%. This shows lenders that you're responsible with your credit and not overextending yourself financially. Now, how can you lower your credit utilization? There are a few strategies you can employ. First, aim to pay off your balances in full each month. By doing this, you're not only keeping your credit utilization low, but you're also avoiding interest charges. Second, consider spreading out your charges across multiple credit cards, instead of piling all your expenses onto one card. This can help keep the utilization rate on each card low. Third, if you can afford to, make multiple payments throughout the month. This can help keep your balance low and thus your utilization rate. Lastly, you can also request a credit limit increase from your credit card issuer. However, be careful with this strategy, as it can be a double-edged sword. A higher credit limit can lead to more spending if not managed carefully. In conclusion, credit utilization is a crucial component of your credit score, and lowering it is a smart way to bolster your financial health. Remember, it's not just about having credit, it's about managing it wisely. Lowering your credit utilization not only increases your credit limit, but also improves your credit score. Once you've managed your credit well, it's time to request a credit limit increase. So, how exactly do you go about this? Let's delve into a step-by-step guide. Step 1. Assess your credit standing. Before you make that request, ensure your credit is in good shape. Lenders are more likely to approve your request if you've been making your payments on time and have a low credit utilization ratio. Step 2. Determine your need. Why do you need an increase? Is it to lower your credit utilization rate or to fund a big purchase? Whatever your reason, make sure it's a financially sound decision and not merely a means to spend beyond your means. Step 3. Research your credit card issuer's policies. Some lenders might automatically increase your credit limit over time, while others require you to initiate the request. Understand their process to avoid any surprises. Step 4. Make the request. You can usually do this online or over the phone. Be prepared to provide information about your income, employment, and housing costs. Step 5. Wait for the decision. This typically takes a few days, but it could take longer depending on your lender. Now, let's talk about the potential impact of this request on your credit score. When you request a credit limit increase, your lender may perform a hard inquiry on your credit report, which could temporarily lower your score. However, the impact is often minimal and short-lived. If your request is approved and you don't increase your spending, your credit utilization ratio will decrease, which can positively affect your credit score over time. So, there are pros and cons. On one hand, a higher credit limit can give you more financial flexibility. It can also help improve your credit score if used responsibly. On the other hand, it could lead to higher spending and debt if not managed properly. Always remember to request a credit limit increase responsibly. Consider your financial situation and habits before making this decision. And as always, continue to make your payments on time and keep your credit utilization low. These are key to maintaining a healthy credit score. Now that you've achieved a higher credit limit, it's important to maintain good credit habits. Ascend the ladder of financial success. It's not just about reaching a higher credit limit, it's about nurturing those habits that got you there in the first place. After all, good credit habits are the cornerstone of financial stability. Firstly, keep a keen eye on your credit card balances. A higher credit limit doesn't mean you should max out your credit card. Always aim to keep your credit utilization ratio low, ideally below 30%. This is the balance you're carrying compared to your overall credit limit. It's a key factor that credit bureaus consider when calculating your credit score. Next, remember the importance of timely payments. Each on-time payment is a positive mark on your credit report and keeps your score healthy. Consider setting up automatic payments or reminders to ensure you never miss a due date. Thirdly, keep your accounts open. Even if you're not using a particular credit card often, it's beneficial to keep it open. Closing an account could reduce your overall credit limit and increase your credit utilization ratio, which can negatively impact your credit score. Also, don't forget to monitor your credit report regularly. It's your financial report card, and it's essential to ensure it's accurate. If you spot any errors or discrepancies, report them immediately. And lastly, diversify your credit mix. A combination of different types of credit, such as credit cards, retail accounts, installment loans, finance company accounts, and mortgage loans, can positively impact your credit score. So let's recap. Keep your balances low, make payments on time, don't close old accounts, monitor your credit report, and diversify your credit mix. Remember, it's not just about maintaining your current credit score, but also about improving it. Staying disciplined with these habits will not only help maintain your higher credit limit, but also pave the way for further financial success. Good credit habits are the foundation of a healthy financial future. Practice them consistently, and you'll be well on your way to a strong credit score and a secure financial standing. Let's quickly recap what we've discussed today. We started with understanding credit. It's more than just a card, it's a reflection of your financial responsibility. We then moved on to the importance of making timely payments. Remember, consistency is key to maintaining a good credit score. Next, we dove into the significance of lowering your credit utilization. The lower, the better. Aim to keep it under 30% of your total credit limit. We then covered how to responsibly request a credit limit increase. It's not about having more to spend, but about having a buffer for your credit utilization. Finally, we talked about maintaining good credit habits, keeping up with payments, monitoring your credit utilization, and being mindful of your credit limit are all part of this ongoing process. Remember, increasing your credit limit without hurting your credit score is a process. But with these steps, you're well on your way to financial success.